Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Whitehaven Coal, ASX code WHC. Good morning, Elio.
Yeah, g'day, Phil. How you going? Obviously, it's been pretty cold down here in down south, and no doubt it's been cold there in Sydney as well, where the forecasters can be believed. And I think there is an immediate need for this, and it is a bit of a staple when it comes to many income-seeking investors, Whitehaven. And it's good to talk about its dynamics at the moment and why we feel there's still life in the old girl, particularly given its price has come back off recent 52-week highs and may prove an opportunity to those who have the stomach for it.
So when you suggested this stock to talk about, you referred to it as a head-scratcher. Why is that?
I like the business, Phil. To me, it's cheap. It spits cash, and obviously we need coal for the immediate future unless we want to freeze, of course. But to be honest, the big deal for me was the acquisition of the Daunia and Blackwater projects from BHP and Mitsubishi Development Proprietary Limited. Only cost of $3.2 billion, thanks very much. But really it is transformative in my view. It's a big deal for two reasons. One, it basically doubles their production overnight. And two, it gives them exposure to metallurgical coal, otherwise known as coking coal. Basically, previously, they were only exposed to thermal coal, what we know as dirty coal, used in power generation. So these acquisitions not only diversify their earnings somewhat, but it also gives them an added element of stability to their businesses. Coking coal, or met coal, used in steel making is a lot harder to replace than thermal coal. And they generate so much cash, basically, that they should be able to pay back the debt that they've acquired on the back of this acquisition in no time. And further, basically, they've got exposure to that broader Asian market now as well, as coke is a lot easier to transport. And there's already strong relationships that have been forged already and done much of the work for them. So, it just makes a lot of sense to me in regards to that recent acquisition.
But you're lining up against all of the analysts at Macquarie who are calling for a lower price target because of headwinds. What sort of headwinds are they referring to?
So unless you've been living under a rock, Phil, I think you would have noticed that obviously Whitehaven is a price taker. Basically, no matter what they do operationally, if the price of coal is falling, then this affects Whitehaven quite closely. And let's face it, with the China hope trade running out of steam recently, the property sector over there on its knees being bailed out by the government. And it's only fair enough, I might add, just as a bit of a segue, the construction sector makes up a large part of the Chinese economy. In fact, I read somewhere it makes up around 1/5 or 1/4 of all of China's GDP. So stocks like Evergrande and Country Garden, even though what they write in terms of debt isn't worth much, ultimately you need them, because if you don't have them, then steel mills close around the country. And obviously we've seen iron ore fall below $100 per ton recently on the disappearance of that China hope trade. It hasn't been great for met coal demand, to be quite honest. Thermal hasn't been too bad. In fact, Newcastle prices have been holding their own in recent times, which has been pleasing. But the company did say that it is about to sell 20% of Blackwater to global steel producers as a strategic joint venture partner. That is progressing to plan, according to them, and they will announce something in the not-too-distant future. And obviously, this will bring down any future burden. But the Macquarie analyst is obviously looking at the price of energy, and let's face it, it's going to go down in many cases. But obviously, when you're trying to pick up an investment in a business, you try to look through the cycle. And as a result, if you're going to cop a downgrade, and that's had a big impact on our momentum ranking, we'll talk about that in a moment, obviously that's going to have a big say in regards to the outcome of this business. But obviously we're staying against the tide in this regard, and this pick is definitely more than the length of your nose, Phil. We are looking at an investment here through the cycle.
And they also recently sold the Blackwater Mine. Why did they do that, and what effect will that have on the balance sheet and shareholder returns?
So just to be clear, it is that 20% of Blackwater, so it's not the whole box and dice. Obviously, This is a big acquisition for the business, and therefore doing that will do two things. One, obviously reduce the load on the balance sheet in regards to the amount of debt that they take on. But two, more importantly, is that it establishes a joint venture partner who has skin in the game, as it were, and ultimately makes Blackwater a success, even though the most recent quarterly shows how transformative it actually has been. In our view, not too significant. And in the recent quarterly that the company produced, they said that their pro forma revenues, they're expecting around 70% of it to come from met coal and 30% to come from thermal coal, because coke commands that premium on the open market. And therefore, on the back of that, we would expect this to still be quite solid and strong. And in fact, if they do sell that portion of the Blackwater mine, we think that'll be a net positive as well for the firm moving forward.
So, Elio, are we squeamish about ESG and the current outlook that many people have about coal and climate change?
It's an interesting comment, because unless you're a die-hard on-the-wall Liberal voter justifying Scott Morrison's black coal stunt back in 2017, ESG has to be considered when investing in Whitehaven. Basically, your fund managers are considering it, therefore, so should you. If you've crossed that bridge, then basically you move on to stage 2. And when you're talking about Whitehaven and the price of coal moving forward and what that means, you have to mention the government, especially at state level, because basically where there's a golden goose, prepare for some scrambled eggs. I think it's fair to suggest that. So following the completion of the coal reservation scheme that the New South Wales government had, they actually lifted their royalties on open cut mining, which includes coal as well. I think open cut at something like 10.8% now versus underground mining where it's 9.8%. In Queensland, to much fanfare and coverage in the media, of course, we saw the introduction of the 3 new tiers that were included. Basically, if the price of coal was around $175 or above $175 US a tonne, then that was 30% of that. And then it went to, I think it was 40% if it was above 225. And then, 40% if it went above 300. If it went above 225, it was 30%. And then obviously 20% is if it went above $175 per tonne. Now, currently, for those interested, the price of coking coal it's had a bit of a fall in recent times, again on the back of that China hope trade diminishing. Currently, it's sitting around $220 US per tonne, which puts them at that 20% royalty position at the moment. But yeah, look, thermal coal, though, in Newcastle, as mentioned earlier, is pretty solid and has been rebounding somewhat, currently around $140 US per tonne. So at the very least, what they're extracting out of the ground, notwithstanding the concerns over coking coal, I think that will be somewhat insulated by the joint venture interest that they'll have and the good production profile that comes from these assets, as it were. And yeah, obviously, if you're worried about saving the planet, then Whitehaven's probably not going to be for you, and that's fine. It's not for me to pontificate whether it does or not. In fact, the market's been suggesting that when it's trading on a PE of only 4.7 times, it tells us that irrespective of how good it's been and how good it's done in the past, it's going to always carry a perennial discount, and Whitehaven's done that in recent times.
So finally, we've got a company with a good value ranking, which are few and far between. Is that value ranking a reflection of the way the market sees it, as you just referred to?
Yeah, unfortunately it is. And as you alluded to, Phil, it does have a good value ranking at 89. And, that often investors will look at it. If you came in from Mars and you understood how to look at the market, coal stocks will be popping up on your radar everywhere. I mean, as I alluded to with regards to Whitehaven's on a price to PE valuation or around 4.7 times, EV to EBITDA of only 2.7 times. The dividend, which has come down on the back of, or expected to come down on the back of these recent acquisitions, still around 2.89%, but it's been much higher than that and definitely better than a kick in the teeth. So in regards to its value metrics, it's actually done quite well, irrespective of the fact that they've been very heavy asset-based, as it were. Now, they will be moving forward, breaking up their business basically along state of origin lines, where you'll have a New South Wales business and a Queensland business. And over its fourth quarter, basically it had its first ever full quarter result from the Queensland business. And, basically we saw what those Queensland assets are going to bring to the table. Run-of-the-mine production hit 9.7 million tonnes, and in total, that is. and 4.8 million of that came from the new Queensland assets. And then you can look at the New South Wales business, which includes the traditional Maules Creek, Narrabri, as well as GOC. We saw 13% over the quarter, and a big part of that gain being a much improved performance from Narrabri. That offset some slight misses in regards to Maules Creek and Gunnedah open cuts. That's what GOC stands for. So you can't help but say that it's cheap, and it's definitely been spinning cash. And to be frank, it needed to do something with all that cash it was generating. It couldn't just be paying that out in dividends, notwithstanding many dividend investors probably would have been happy with that. But I feel that using these extra cash to go about investing in these sorts of plans does diversify and strengthen the business and give it a good overall solid ranking rather than it just being so focused on dirty coal, which has its obvious issues as we've discussed and as you've implied in your questions.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So let's have a look and dig into those numbers that contribute to that good value ranking and the quality of this company.
Yeah, so I think you touched on it there, that actually its highest ranking, so it ranks 84 overall on a stock rank perspective. So it's up there in the upper echelon and sits in the top 20% of all stocks listed on the stock exchange, which is still a healthy number of 400 odd that it's benchmarked against. So that it's important to remember that. And you touched on value, because it's often strange to find a value opportunity whereby its price has done relatively okay in recent times. But obviously, we know that there's that inverse relationship between share price and value. But in this case, there is still value in this stock, but it's actually not the highest ranking. So the highest ranking actually goes to quality, and you got to support that with, we're talking about return on capital of 25%. We're talking return on equity of 22%, very strong operating margins at around 40%. The company is unlikely to go broke, though it will be interesting to analyse their balance sheet when that comes out on the 22nd of August for the keen watchers of the annual financial statement. In terms of bankruptcy risk leading up to that, there was a minimal amount. We feel there was plenty of capacity on the balance sheet to be able to absorb this acquisition. Further to that, its M-score is actually low, so there's good cash conversion as well. So in terms of quality, it ranks as 92, and that actually gives it the highest ranking out of the three. We touched on value, and that looks quite good. Where it fails is momentum. And keen listeners would have picked up your question in regards to recent downgrades that have come on it. And it's important for me to stress that momentum is not just about price, obviously. That plays a component, but it's also about analyst revisions. And because of the failing China hope trade, as I alluded to, the fact that power prices are expected to ease somewhat, the government's keen eye in regards to what's occurring there at a wholesale price level, and no doubt where it actually comes from, they're going to be very interested there. And we've heard policy potential changes and a whole range of other different things. Analysts have been forced to downgrade their earnings expectations on these businesses, including of which Whitehaven is definitely one of those. And that has actually led to a big cut in the momentum score. And it's actually ranking a 40 at the moment, irrespective of the fact that, over the 12 months, the price is still higher. But that analyst downgrade run that it's had in recent times in particular has really weighed on the overall stock, and investors need to be conscious of that. So you would be standing against the tide in regards to this hill if you are going to take an exposure now. But I feel that it's definitely better buying today than what it was 3 weeks ago. And therefore, as a result of that, that could possibly prove to be an opportunity. But of course, there are many factors that need to be considered with regards to Whitehaven. And ESG, as you alluded to at the start, is obviously only one of them. Many more to come.
Yeah, there's so many moving parts playing on this company, isn't it? So what are you looking at as the outlook for coal and this company in particular?
Look, it's really interesting. I'll start with the coal market dynamics. And basically, in a recent quarterly report that the company provided, they told us that met coal is expected to be a larger part of their overall mix, which obviously gives us some heart. Further, they see long-term production constraints of hard coking coal, or what they call HCC, from Australian producers, combined with increased demand for seaborne coal from India. That should also drive higher metallurgical coal prices into the future. And what they realized was around $240 per ton. As I alluded to, it's probably going to be about $20 to $30 less than that at the moment. That's what was realized in that last quarter. Obviously, that is one thing. So if you assume that coal is going to be needed and it still needs to be there, then that's fine, particularly steel or metallurgical coal, because obviously we know about energy and we know of the possible replacements that could be happening there. But if you scratch a little deeper beneath the surface, you actually see that there aren't as many replacements for steel generating coal. And therefore, as a result, the demand for that is likely to remain for quite a bit longer than what, say, thermal coal would be, even though they haven't given up on the old girl yet. I mean, for example, they've got further development to do in places like Winchester South, which should be a good addition to the Queensland business. There's also the Narrabri Extension Project, which will give it an extra 13 years of mine life to something like 2044 if they prove successful. Both projects are waiting for approvals before they commence, of course, as you would expect. And to date, they've received favourable rulings, but of course, you can never say never in this contentious asset class. Therefore, when you think that there's extra production possibly coming online, further supported by the fact that when you're looking at met coal, which should make up a larger part of their broader mix, plus the JV deal that hopefully they eventually sign, notwithstanding they have to give up some of Blackwater in order to do that, one would think the outlook for a Whitehaven looks pretty solid, but as a price taker, it's always going to be subjected to the price of the underlying commodity that they work with. And often when you get these companies that make up such a large part of the broader market, as it were, you're going to find that its price reflects more the commodity rather than operational issues, even though operationally I think this company has actually done quite well. And if you can stomach the fact that dividend yield is expected to come down and that what they're doing is expected to be a benefit for them over the longer term, then I think now might be a good opportunity to have a look at Whitehaven.
So are there any other risks for listeners to consider? I mean, there's a lot here that you've mentioned, but anything else that we should be aware of?
Well, obviously, you can fill your sock when it comes to risk. Probably not too many, other than just a reminder that when you are invested in, whether it's Whitehaven or anyone else, say gold producers or whatever the case may be, that it's a hedged exposure to the underlying commodity. So notwithstanding the fact that the commodity price of a price taker will go up or down, along the lines of that, you've also got operational issues. So if there's a problem at one of their mines, it has a bigger impact on the share price, and therefore it can be disconnected from the underlying price of the commodity it deals with. So always keep that in mind, that notwithstanding the fact that, yes, it's obviously a coal play and obviously you're dealing with that commodity price is going to do a lot in regards to the earnings that they're able to generate. All they can control is production, basically, and the amount of resource they got under the ground. And in the case of Whitehaven, they're doing okay with regards to that, notwithstanding some recent hiccups in a few years ago and the like, and where they're at the moment. But moving forward, I think they've made some shrewd acquisitions and they seem to be going okay. And if this recent quarterly was any guide, things seem to be stable. And I think we saw that appreciation with the price up, and we've seen the price come back, which again proves that opportunity for savvy investors.
And as you say, the demand for steel is not going down, and there's only one way to create steel at this stage, isn't there?
Yeah, look, that is true. I mean, I've been a China bear of recent times, and have been because many of those ghost cities that they built, I've always argued they could tear them down and build them up again, which is still very much true in regards to the size of the Chinese economy. But its large place as a player in the GDP of the entire nation, plus the recent troubles of some very big property developers, does mean that it is on watch. And obviously, whilst making the steel doesn't change, the amount of steel that's needed can change. And therefore, investors need to be cognizant of that. And as you allude to, a very real risk that people need to be aware of when considering an investment in Whitehaven, because that would impact the coal price and then the various knock-through impacts that can occur as a result.
Elio D'Amato, thanks so much for joining me again.
Thank you, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.